Rightio, I think they might do it. There's still people trickling in, but again, that's fine. Everyone seems to be able to hear me okay, so let's jump start into it. So as we know, and while we're here for the main residence exemption webinar for Australian expats. Myself, I'm James Ridley. I'm one of the directors here at Atlas Wealth Management. Before we kickstart, as always, with all things business related or advice related, we're just going to go through a quick legal disclaimer. Unfortunately, I do need to read it all out as per our compliance solicitor has notified me. So this presentation is made on the basis that it contains only general as opposed to personal advice. This means it has been prepared for multiple distribution without consideration of your investment objectives, financial situation and needs or personal circumstances. Accordingly, the information given is not a recommendation that a particular course of action is suitable for you, and the advice is therefore not to be acted on as financial advice. You must assess whether or not the advice is appropriate for your personal circumstances before making any financial decisions. If you require assistance with this or a personal recommendation, you can seek the assistance of a tax accountant, tax lawyer, or financial advisor. Just some general housekeeping as we get into it. This recording is going to be made available, not necessarily straight after the call, but probably throughout the week. We're going to put it up on YouTube as well as on our website. My colleague and business partner, Brett Evans, he's doing one later this afternoon. His will also be available. I think if you're hearing this now, probably some important things that you really want to go back and reflect on is probably the Q&A at the end, because all expats have the same issues when it comes to this particular legislation. As we progress through the slides, I would ask that you do submit your questions, anything specific. I'll try and address them mainly at the end, just so we can get through the majority of the content, and then we'll come back around to those Q&As. As I said, I'll do my best to try and address everyone's question. So let's jump into it. So just a brief intro. Who is Atlas Wealth Management? Well, Atlas Wealth Management, we're the leading provider of financial advice to Australian expats. We've won multiple domestic and international awards. We've got clients now in over 28 countries, with all our financial advisors being postgraduate and holding postgraduate certifications. We are the global financial advisors to Australian expats. Now let's move into the agenda. So who this webinar relates to, what is the main residence exemption, what are the new rules with the main residence exemption, how does it affect deceased estates, a case study on the old main residence exemption rules, a case study on the new main residence exemption rules, what the foreign resident capital gains withholding tax is, unforeseen issues which may now present themselves based on this new piece of legislation, some short tax planning strategies, and a Q&A at the end. So that's today's agenda. So let's move through it. So today's topic, so obviously the legislative change to the main residence exemption now that it's been abolished. So who this pertains to. So an Australian expat or a non-resident of Australia for tax purposes, own a main resident or a former main resident that is currently rented, and they're thinking of selling this property in the future. This is not related to an Australian expat that holds an investment property, including a commercial property, that has never been your main residence. So if you've tuned into this webinar today and you only own an investment property, you've never moved into it, then today's webinar isn't relevant for you. So technically you can tune out if you wish. Obviously, important thing about obviously the rule of law when it comes to legislation is that it's meant to operate in that prospective manner. As we all know, this new update is draconian and I suppose purely retrospective in its nature. So what is the main residence exemption? So let's go into what the old rules are and let's address that now. So the rule of law for the main residence exemption has previously been that no capital gains tax should apply to a person's main residence. So the relevant legislation that this relates to was established back in the Income Tax Assessment Act 1997 and it was established after they brought in capital gains tax in on the 20th of September 1985. So this relates to that 6-year rule whereby if we're renting out a property that was our main residence. Now let's delve deeper into that main residence exemption. So in the event that a main residence exemption becomes an income producing asset, example, we move into our property, we purchase it and then we move out and then we rent it out and the owners do not establish or purchase a new main residence, then a 6-year capital gains tax relief rule applies to that property. So if the main residence is sold and had been rented out for less than 6 years, no capital gains tax is payable and the owner benefits from the main residence exemption in full. If the main residence is sold and had been rented out for 6 years or more, then a pro-rated amount of capital gains tax is payable and the owners benefit from what's called a partial main residence exemption. And in this case, the market value rule applies as of the first day of renting it out, which it means that the cost base for capital gains tax purposes resets. So just more on that market value rule, I just want to flesh that out a bit more. So when renting out a former main residence and only a partial main residence exemption is relevant due to renting out over that 6-year period, the cost base of the property resets to the market value of the property when the property was first rented. So in those cases, it's important that you go out and seek an independent valuation. Otherwise, an accountant, tax agent can use what's called the apportionment factor, where they use the different periods of days that you've held it as a non-resident versus a resident and the period in which it's rented over that 6-year rule. But we'll go into that into an example that's coming. A small note here, resuming living in your main residence can reset the 6-year period. This is under the assumption that you've only rented it out for, say, 5 years, and then you move back into it, and then you're resetting that 6-year rule. Now that's the old main residence exemption. Again here, the residency status had no impact on whether you could use the main residence exemption. So moving in now to the new rules. What are the new rules with the main residence exemption? Well, firstly, if you sell a former main residence and you are a non-resident at the time, you cannot access the main residence exemption. There's an important note that obviously the transitional rules apply for owners who purchased their main residence before 9th of May 2017. The transition rule states that that is up to 30th of June 2020. That's the period we have until we need to decide whether to sell, whether to hold. There's also the exception to the new legislation where they've inserted these certain caveats. Unless in extreme circumstances a certain life event takes place and you are not an excluded foreign resident. So we'll go into that shortly. So more on the new legislation. So all of the capital gain is taxable by the Australian Taxation Office. There is no partial main residence exemption available. The cost base is equal to the purchase price, assuming no significant capital works have taken place. Therefore, that market value rule, as previously discussed, has been thrown out for purposes of the new main residence exemption. Capital gains will be taxed at the non-resident tax rates. So this is an important one because remember, as a non-resident, we do not have a tax-free threshold. We pay tax at the first tier, 32.5% up to 90,000. The next tier is 37% up to 180,000. And then again, after that, it's straight up to 45%. So a huge amount of tax can be paid. It's an important consideration because a lot of people forget that they don't have a tax-free threshold and they don't benefit from that other tier. A 50% capital gains discount might apply. I'm going to pause it there just to explain what that CGT concession is. So a 50% CGT concession exists for mainly ordinary Australian tax residents where if we buy an investment, a share, a property, we hold that investment for a period greater than 12 months and then we sell it after that period, we can then we only have to declare 50% of the capital gain in our individual tax return. So only paying tax on 50% of the capital gain. That's the concession, which is mainly open to normal Australian tax residents. Now you'll note here that as of 8th of May 2012, the CGT discount concession was removed for periods of non-residency. However, there are various methods to calculate the CGT discount. So again, just discussing that a bit more, regardless that it was removed as of the 8th of May 2012, if you were a normal Australian tax resident, they will still benefit from this up until the period that you left Australia. So you can benefit from that main residence, that 50% capital gains tax discount concession if you were still a normal Australian tax resident after 2012, even though you might sell that property as a non-resident. So that's just a careful sort of note and disclaimer to remember there. Properties purchased before 9th of May 2017 will benefit from the transition period to 30th of June 2020. So just touching on that again. Contracts must be signed before 30 June 2020. Settlement can take place in the new financial year. So I've had a lot of queries about this one from a lot of individuals about when is crucial dates. Contract again must be signed before 30th of June 2020. Settlement can take place in the new financial year, that's fine. Properties purchased after 9th of May 2017 do not benefit from the transitional rules. So this has caused a lot of confusion. But essentially, if you've purchased your former main residence, which you might be renting out now, after the 9th of May 2017, and you're thinking of selling it now, before 30th of June 2020, the tax treatment is essentially you will not benefit from any period that you lived in that property. You do not benefit from the main residence exemption at all. So just remember that the transitional period is only for individuals that purchase those main residences before 9th of May 2017. Again, as a summary, the period you lived in the property accounts for nothing and is disregarded, as well as the period of Australian tax residency for the new legislation. Very damaging. Moving further into the summary, tax residency at the time of sale is the determining factor as to whether you can benefit from the old main residence exemption rule after 2020. So a key question that I'm getting at the moment is, well, what does it take to resume being an Australian tax resident again? What's the time frame? You know, what do I have to do? And it is a big grey area, and it's not something you want to do lightly. And you know, you should really, if you are going to commit to coming back, really commit, and you should be here for quite a good period as well. So when we think about what it takes to re-establish tax residency, consider the residency criteria when you first became a non-resident. So the primary test is the resides test. So where you're residing permanently. So in the event you're coming back to re-establish your Australian tax residency, then you'll be returning here permanently. It's likely that the wife, the kids, they'll be returning with you. Your circumstances will match that of an individual that has returned permanently. You'll either have a rental lease in your name, 6 to 12 months. You'll have an internet account. You'll have a power bill, phone bill, maybe obviously working again. So these are all key considerations and factors that the ATO considers in the event they ever choose to audit you as to whether you are satisfying being a normal Australian tax resident again. The other secondary test that we've put here is obviously the 183-day rule in the same financial year, so residing in Australia for a period of greater than 183 days in the same financial year. Domicile tests, obviously being domiciled inside Australia, having that permanent place of abode. The last test here is that Australian Government Employee Super Contribution Test. I'm not going to go into that one. It's mainly a consideration for non-residents when they are becoming a non-resident, not specific here. So again, habits need to resemble someone who has returned permanently. It's a bit of a grey area, and my concern is that a lot of individuals will be wanting to benefit from the main residence exemption, and they're going to be coming back for very short periods. In the event that the ATO thinks you're doing this and you haven't actually re-established your residency permanently, they will lean on this rule. So the Commissioner of Taxation will be using Part 4A, an anti-avoidance rule for income tax, where they can challenge up to 4 previous financial years. So just bear that in mind. Moving through, so what is an excluded foreign resident? So a foreign resident may be able to access the CGT main residence exemption if they satisfy the life events test. The first element of the life events test that required at the time of the CGT event is that the person is not an excluded foreign resident. Excluded foreign resident. So a foreign resident at the time the capital gains tax event occurs, and you've been a foreign resident for a continuous period of greater than 6 years. Greater than 6 years. So you've been a non-resident for tax purposes of Australia for a period greater than 6 years. So just to recap, the life events test can apply to someone who has been a foreign resident for a period less than 6 years, and we're going to go into that now. So what is a life event? So in order to benefit from the main residence exemption, a life event must occur within that first 6 years of you being a foreign resident. A life event is a terminal medical condition or diagnosis, so you, your spouse, or your child under the age of 18 years, a death, yourself, spouse, child under the age of 18 years, or a divorce or separation you or your spouse. In the event it's a divorce, make sure you have a court order and a ruling that says that their property must be sold or transferred to one of the individuals. So the life events is essentially one of these taking place, and due to one of these taking place, you're having to sell the former main residence. So one of those events, obviously you can see here that the government's introduced these life events to try and preserve that capital under the assumption that you've only been overseas, a non-resident, within a 6-year period. If you're over, you cannot apply any of these, unfortunately. Moving through now onto how does this affect deceased estates? So this is always a little bit wordy, but we've tried to make it a bit clear. So the deceased at the time is a non-resident. So the deceased is a non-resident at the time of death. So the beneficiary is not entitled to the main residence exemption if the deceased had been a non-resident for a period greater than 6 years. So i.e. they're an excluded foreign resident. The beneficiary of a deceased estate is a foreign resident. So a beneficiary is entitled to the portion of the main residence exemption if the deceased was not an excluded foreign resident. Just bear in mind that that's an example of one of those life events. So again, the beneficiary of a deceased estate is a foreign resident. A beneficiary is entitled to the portion of the main residence exemption if the deceased was not an excluded foreign resident. So they hadn't been overseas for a period greater than 6 years. If the beneficiary was a normal Australian tax resident, they will have the benefit of the 2-year grace period from the date of death. I'm just going to pause on that and explain what that 2-year grace period is. So in the event we receive an inheritance of a former main residence, we have 2 years to decide what to do with that main residence. We can rent it out for a period and then sell it. We can sell it straight away, or we might move into it and establish it as our main residence. In the event we rent it out, and we rent it out past that 2-year grace period, it means that it's likely that capital gains tax will apply for that period of renting it over the 2 years, and we will still benefit from the main residence exemption prior from the deceased's period of having it as a main residence. It's a little bit wordy, and I apologise for that, but when in these circumstances, it's important to seek advice just for clarification. The last point here, a non-resident beneficiary will only get the portion of the main residence exemption for the deceased non-resident, as well as the 2-year grace period. So they still have 2 years to decide what they're going to do with the property. Moving into some case studies now. So firstly, we're going to touch on the old main residence exemption rules, and then we're going to move into the new rules just to show the damaging effects of the tax consequences. So firstly, Jack and Jill bought a house in Sydney in 1994 for $350,000. They move in immediately and establish it as their main residence. In 2017, Jill is offered a dream job at Google in the US. They move overseas and become non-residents for tax purposes and rent out the main residence. The house at this time is valued at $1,400,000. In 2022, they decide to sell their main residence for $2,500,000. Bear in mind, these are really simple cases and really simple calculations. So the total capital gain is $2,150,000. So obviously just that 2.5 million minus the 350,000. Taxable capital gain based under the old rules is $0. Why? As the main residence exemption covers them for the total period. They lived in the property for 23 years. They rented the property for 5 years. So therefore, that is within the 6-year exemption period of the main residence exemption. Let's now look at a case study of a partial main residence exemption. So Tom and Chloe purchased their dream waterfront home on the Gold Coast for $500,000 in 2003. In 2016, Tom is offered a role overseas in Singapore. They move overseas and rent out their home, which is now valued at $1.3 million. In 2025, Tom and Chloe have the tenants move out and leave the house vacant as they intend on returning home. In 2027, they sell the home for $2,700,000 and the house has been vacant since 2025 as Tom and Chloe's plans changed and they did not re-tenant the property. Let's move into the calculations. So Over that period of total ownership, the total capital gain was $2,200,000. Just remember now, the market value rule is in effect as they've rented it out over that 6-year period. This reduces the capital gain to $1,400,000. So remember, the market value rule applies for when they first rented the property. Obviously, you need to seek an independent valuation to get to that value for ATO purposes. A real estate agent is not good enough. Years property was owned, 24 years. Years main residence exemption was used for the 6 years, yes. Years not main residence for rental period. So this was the 3 years that they rented out over that 6 years. Years the property was vacant, 2 years. Remember, 2 years when the property is vacant, this doesn't account or, I suppose, contribute to that period being taxable. So that's important to remember. So therefore, we calculate the taxable capital gain based on this fraction. 3 years divided by 24 years equals 12.50%. 12.5% times the reduced capital gain, 1.4 million, equates to a taxable capital gain of 175,000. So just an important one there. We're now going to move into a case study of the new main residence exemption rules. So just going to move over to the next slide, trying to use the exact same, I suppose, cases just so we can make a clear comparison. Same again, Jack and Jill bought a house in Sydney in 1994 for $350,000, move in immediately establishing it as their main residence. In 2017, Jill is offered a dream job at Google in the US. They move overseas and become non-residents for tax purposes and rent out the main residence. The house is valued at $1,400,000. In 2022, they decide to sell their main residence for $2,500,000. As we know, the total capital gain was $2,150,000. The 50% CGT discount applies to the 8th of May 2012. Remember, with the old rules, the total period was completely tax-free. But now that it is taxable, we can still utilise this 50% CGT discount concession. So let's go through the years of periods. We've got from 2012 to 1994, working backwards, 18 years. 2017, 1994, 23 years. So let's work that out as a fraction. 18 divided by 23, 78.26%. To work out the discount that applies, 50% times 78.26% equates to 39.13%. Therefore, the taxable capital gain is $1,308,705. The tax-free gain is $841,295 with some brief examples of how to work out that calculation there. So let's look at this example from how much tax would now be owed based on them being non-residents. So again, recap, tax rates. First tier to 90,000, the rate is 32.5%. The next tier over 90,000 to 180 is 37%, and again over 180 is 45%. So based on those tax rates, and under the assumption that they both own the property 50-50, the total tax that Jack and Jill will pay each is $276,008.63, or that combined amount $552,017.30. If it was a sole individual, this would actually equate to slightly a higher amount, just because obviously based on the tiers, like no opportunity to split the gain down the middle. So $570,467.25. So as you can see, a significant tax payable, which is very concerning. The next slides that we're going to briefly touch on is the foreign resident capital gains withholding tax. Not a lot of people are aware of this tax. I thought it would be a good item to bring into this PowerPoint, just because in the event you're looking to sell now or after and you're a non-resident at the time of the transaction, this will apply. So what is the foreign resident capital gains withholding tax? Well, let's go into it. So it was introduced on the 9th of May 2017, the exact same day that they introduced the abolishment of the main residence exemption, or a few years back in the budget. For property sale where the contract is over $750,000, the withholding rate is 12.5% of the contract price. It used to be 10%, but they've increased it to 12.5%. The purchaser has an obligation to withhold 12.5% of the purchase price and pay this to the ATO. So why was it introduced? Well, apparently a lot of foreign residents or non-residents, when they were selling these houses, and in the event it was technically a taxable transaction, they weren't lodging that final tax return, and therefore the ATO wasn't getting a very large amount of tax paid to them. So essentially, so the ATO gets a piece of the pie now, and at the end of the financial year, if too much tax is paid due to the fact that maybe it's covered under the main residence exemption, a partial main residence exemption, or other means, that's when you'll be entitled to a tax refund because you would have paid too much tax due to the withholding amount. So what we've put down here below, what should you do? So in the event you sell a property, and based on that 12.5% amount that is too much being withheld, these are I suppose these are the opportunities to get out of paying that tax or having that tax withheld. So we can obtain a clearance certificate which essentially exempts us from having any tax withheld. We can use a tax agent to vary the amount to 0% if relevant, if covered under the main residence exemption in full. Or if we're too late and a tax agent or the conveyancer doesn't act quickly enough, then it just means that we can go down the path of potentially lodging an early tax return to get that amount of tax back, just because based on a property sale of $750,000 or more, it's a significant amount of tax going to the ATO when sometimes it might not have needed to be. So based on this legislation, these are some of the unforeseen issues that we're going to see arise, unfortunately, and it's going to become more evident over the next few years. So first one there, tax administration burden. So many expats were likely of the opinion that they would not have to pay tax on this type of asset, and therefore it does create an issue to locate original purchase documents, capital works improvements such as renovations or significant repairs, which can change cost-based elements. An unplanned sale. So many expats use their home as their main nest egg as part of their retirement. This means they either sell earlier now or in the future where a large tax bill might be due. The last one, which could be a huge one, we might see that it's going to be forcing expats to end their career pursuits early due to having to return home earlier than expected to either reset the main residence exemption, essentially establishing their tax residency and potentially selling the property or whatever the case, but forcing them to end those career pursuits early due to the main residence exemption being abolished. We're now going to progress into some short tax planning strategies that we can utilise. So we're just going to move into that now. Just going to have a quick sip of water. Just going to pause. I can see here that a few individuals have just said that we keep losing the sound. Can everyone hear me right now? Just either a raise of hands or a few comments in the chat box. Okay, people are coming through saying yes, they can hear me. It might be sometimes just due to your own connection. All good, no issues, sounds okay, all good here. It's good, thanks guys. A few hands being raised as well, which is good. I do apologise if the sound has dropped out every now and then. It could be a connection issue. It might be a connection issue on this side, but everyone seems to be okay, or somewhat the vast majority. Again, the recording could be made available at the end. I'm going to listen back to the recording to make sure there is no sound, I suppose, dropping out. So yeah, just bear that in mind. Michelle, you raised a good point there, and I'm about to address it. Okay, guys, so let's move into these tax reduction strategies. First one, let's move back. We can move back into the property, establish it as our main residence before the 6 years is used up. If you have used up the 6 years, then selling when you're an ordinary tax resident, this will give you the partial main residence exemption. Point 3, using a concessional contribution to your super fund to claim a tax deduction and offset an amount of the capital gain. And lastly, using the catch-up concessional contribution legislation to offset a large portion of the capital gain. I'm just going to put in a big note here. If you're a US resident, you need to be aware of these concessional contributions strategies. It's mainly due to the way that in which the IRS classifies superannuation. They don't treat it as a foreign pension. There's no carve-out in the double taxation agreement. So it is highly likely that these type of contributions to your super fund can sometimes be taxable depending on the treatment of your individual super fund. So just a caveat there, just to be careful there. Let's move into just the bottom two, the concessional contribution strategies, as the top two are somewhat self-explanatory. Again, if you're sending through questions, now's a good time because we'll come to questions shortly. Concessional contribution strategy. So firstly, let's just address some brief criteria in order to be able to contribute. So to be able to contribute to super, we must first make sure we have not maxed out our concessional contribution cap in the current financial year. We are eligible to contribute to super age 65 or less. If age 65 to 74, must be gainfully employed or meet the work test 40 hours in 30 consecutive days. The exempt from this test if your super balance is less than 300,000 at 30 June of the previous financial year. What is a concessional contribution? It's a pre-tax contribution to our super fund, which on its way in is taxed at a flat rate of 15%. Our annual contribution cap is 25,000. If anyone that is listening to this webinar right now and you have a self-managed super fund and you are a non-resident, do be careful contributing to it just due to the central management and control rules, and you don't want to be seen as running a non-compliant self-managed super fund. So just a short warning there. If we move over to the next slide, let's look at this strategy in practice. Jane is a non-resident and sells her main residence on the 2nd of July 2020. Jane realises a capital gain on the sale of her main residence of $35,000. Jane has not previously contributed to super prior to this in the 2021 financial year, bearing in mind we're only 2 days into that financial year. If Jane does nothing, she'll pay the following tax. 32.5% times 35,000 equates to $11,375. So a good lump sum tax on the capital gain. If Jane utilises her concessional contribution cap in that year, deposits 25,000 into super, which is taxed at 15% on the way in, this equates to $3,750. Therefore, only pays non-resident rates at $10,000 at 32.5% of $3,250. Therefore, the total tax paid is $7,000. The tax that she has saved out of pocket is $4,375. So a really simple and easy strategy. In order to claim that concessional contribution as a tax deduction, an individual must complete what's called an S290 form. In the event you've completed a personal concessional contribution in a previous year, it's highly likely that a super fund will send you a notification email saying, listen, we've received this contribution. We just want to know whether this is a personal tax deduction or not. It's so they have clear guidance on how to treat it, whether it makes up your tax-free component or your taxed element. Let's look at the catch-up concessional contribution strategy. Let's just go through a brief overview of what it is. So the catch-up concessional contribution rule lets us accumulate our $25,000 concessional contribution cap over a 5-year rolling period, obviously 5 rolling financial years. This means that in year 6, we can effectively create a $150,000 tax deduction. So a huge tax deduction and a great example of what can be used to offset a capital gain, especially at non-resident tax rates. Key items to be aware of. Only allowed to start accumulating unused amounts from the 2019 financial year, so the financial year that has already gone. When contributing, we must satisfy the eligibility criteria, plus our total super balance must be less than $500,000 in the previous financial year. If our balances are over that, then we aren't able to use this catch-up concessional contribution strategy. And as an example right now, we are in the 2020 financial year. Therefore, if we have not contributed anything to super as a concessional contribution last financial year, in the current year we're in right now, we can utilise a $50,000 tax deductible contribution to our super fund. Again, let's move into an example previously seen. Jack and Jill, assumptions, sold property in September 2022. They realised a capital gain of $1,308,705 or $654,352 each. Their super fund balances are under 500,000. They are both eligible to contribute as they're both under the age of 60. Don't be hung up too much on that 60. That's just a random number that we've used. No previous concessional contributions have been made. So we can see here that in the 2019 financial year, 25,000, it's rolled over to 2020, 2021, so on and so forth. So they're selling it in September 2022, which is the 2023 financial year. Therefore, only both have a $125,000 personal tax deductible contribution that they can utilise. Let's look at the effect on their overall tax position of this transaction. So again, realised capital gain, $654,352.50 each. The previous tax that they paid to the ATO each was $276,008. Let's look at the effect. So the catch-up concessional contribution of $125,000 goes into their super fund. They claim it obviously as a tax deduction. The tax that comes out of that contribution is $18,750. Therefore, after that deductible contribution, their net capital gain is $529,352.50. Tax paid outside of super, based on that net amount, is $219,758.63. Therefore, total tax paid is $238,508.63. So we can see there a total tax saving of $37,501 each. So a significant amount of tax saved by using that catch-up concessional contribution strategy. Again, if you're in the US, just be mindful of how that might be treated by the IRS, and it's best to speak with your US tax accountant. Next slide is just summarising thoughts. If you fail to plan, you're planning to fail. You've seen some examples of strategies that you can utilise. We have timeframes to make decisions, obviously a very short time frame. If we're not going to sell, then it's likely that you might hold the property until you return and reside back in Australia. We're now going to move back, we're now going to move into Q&A, and I'll do my best to address as many as I can. I've got some time there. I'm just going to turn off my webcam just so I can read through those questions. So just bear with me. I'm just going to turn that off now. That's going to drop out. There we go. Okay, Q&A. So I appreciate everyone that submitted a question. I'll do my best to try and get through them all. So just bear with me while I just quickly read through some. Unfortunately, I'm the only individual that's doing this today, so bear with me. First question here. Hi, if you're currently a foreign tax resident but in the future move back to Australia, will selling the property fall under the main residence tax exemption again? Yes, you'll note earlier in the slides that the clear defining factor is at the time of transaction when you sell that main residence, are you a normal Australian tax resident or are you a non-resident? If you're a normal Australian tax resident, then the old rules of the main residence exemption will apply to that transaction. So that was one of the case studies as well. In the event we sell a property and we move back, obviously if we haven't rented it out for a period over than 6 years, then we can still sell it and we're still benefiting from that main residence exemption in full because we're a normal Australian tax resident at the time. Again, I think I've just addressed this. If we return to Australia and live in the primary place of residence, again, we can reset the rule. If it's under 6 years and the old main residence exemption applies, again, the defining factor is what our tax residency is at that time of transaction. Probably a good question here. Is there any point of selling the property before June to avoid CGT if they will charge you CGT in the foreign country you're paying tax in? It's a hard question. It's a dual tax question, a dual tax issue question. It depends on obviously the local legislation in the country that you're residing, whether they have any sort of formal legislation about property being your previous main residence. The UK has some legislation on there. The US technically does have some legislation on there, but obviously it's different to ours, different tax rates, different periods of residency, and it being your former main residence. So you would need to seek tax advice from an Australian accountant first on the transaction that might transpire, so such as a what-if analysis, and then a same again on the other side from another tax account, depending on where you're residing, Singapore, US, Hong Kong, whatever it might be. Moving through here. Yes, this session will be available later to view on YouTube. What are the implications for 50-50 ownership and mixed residency status? As example, 1 50% owner lives in the house still. Good question. Great question. Again, if one of the individuals is still a normal Australian tax resident and the other individual is a non-resident, and you do sell the property after 30th of June 2020 and one of those individuals is a non-resident at the time of that transaction, then unfortunately that individual that's a non-resident will not benefit from the main residence exemption at all, whereas the other individual will. The transaction, while it's happening collectively, the tax treatment is very different. One individual will benefit from the main residence exemption, the other won't. Just going through these questions, so just bear with me. This is a good one. I'm just going to read it out. It's a long one, but I'll try my best to get through it. I'm an Australian living overseas for the last 15 years. I inherited a half share in a property with my passing late mother. My husband will purchase the other half from the other beneficiary in the next few months. He is also an Australian non-tax resident. Our children will live in the property until our return in about 6 years. If the house is never rented, will we still have a CGT liability in the future? It's a good question. If the house has never been rented and it's been vacant, just remember the rule where when you inherit a property, you do get that 2-year grace period. If it's not going to be an income producing asset, then technically, yes, you can still benefit from a likely partial main residence exemption. It does depend on dates, periods of non-residency. I can't give you a definitive answer without going into it more there. That's more personal advice side, so I'll leave it at there. But yes, it is potential that you'll still benefit from an exemption portion, absolutely. Moving through, let's have a look here. No, unfortunately not. So what happens if you inherit a property and you've been a non-resident for over 6 years? Do we still get 2-year grace period before we sell? That's a great question. If we're inheriting a property, it depends also who we are inheriting it from, what their tax residency or of the deceased was, because that'll also have an impact as well. So generally speaking, we should get the benefit if we're a foreign resident beneficiary and the individual was, say, a foreign resident but was not an excluded foreign resident, then we should still get the benefit of a 2-year grace period. In the case of a death of one person, if the house is owned jointly and both are non-residents, it is subject to the taxation, or does it just move to the surviving spouse without a tax event? That's a good question. I'm not sure if they're still here, but Phil, that's a good question. Listen, that's actually a life event, which is essentially one of the exclusions, but it needs to take place within that 6-year period of you being a non-resident. In the event it happens after that, then it can be a taxable transaction, unfortunately, when it moves to the surviving spouse. So again, that's a life event. It would depend on certain criteria, but it is one of the life events, so it's highly likely that would be potentially an exemption. Generally speaking, when properties do move over to spouses, it is obviously an exempt or tax exempt transaction. I'm just trying to get through these. Just bear with me. A lot of questions, which is really good to see. Just moving through them. Let's have a look here. So if you rent for longer than 6 years, but then return to Australia and take up residency in that house for another year, what takes place? Well, in that case, you would only benefit from a partial main residence exemption. Remember, the main residence exemption, the old rules state that you can rent out a former main residence under the assumption you haven't gone out and purchased another main residence in Australia for up to 6 years. If you rent out over 6 years, that means that we will still get the benefit of the main residence exemption, assuming when we sell that we're a normal Australian tax resident for that 6-year period. Any period that we've rented out over the 6 years will be taxable in the eyes of the ATO. So that essentially means that we'll get a partial main residence exemption. Again, US residents, an important reminder here, one of the individuals who just put through is that you really need to be careful of either this type of transaction, the way the IRS taxes if you are going to sell, as well as making any contributions to a super fund, just due to the way that the IRS taxes super funds. So important to seek clear guidance from a US accountant on how they are going to treat that in your individual US tax return. A good question here again, how long do you have to move back into the main residence to reset the 6-year rule? Well, it's essentially, it's a bit of a grey area, and I mean, to most individuals, you'd want to prove that you're back in Australia. Generally speaking, minimum 6 months residing back in a property is a good starting point. 12 months to be safe. As I said previously, that the ATO will be leaning on that Part 4A anti-avoidance tax rule in the event individuals are coming back to Australia for a short period selling and then going back overseas. They can technically audit up to 4 financial years previously, so it's a tough one, but yeah, just be careful there. I would say 12 months is safe in over a full financial year. 6 months, caution. Anything less than that, again, I would caution. Sometimes you could even seek a private binding ruling or maybe a specific letter from a tax accountant as well. Just moving through these, just bear with me. Can you accumulate the catch-up concessional contribution as a non-resident? It's a good question, and yes, you can. Superannuation is agnostic, regardless of our tax residency status. For a non-resident or a normal Australian tax resident, we can still contribute. We just need to be mindful of if we are employed by a global company and we are still receiving a contribution into our super fund from our employer, that does make up part of our concessional contribution cap. So if we're receiving the super guarantee from our employer, even though we are a non-resident and we're living and residing overseas, that does, I suppose, that does contribute to our concessional contribution cap. So as an example, if we're receiving $10,000 from our employer, even though we're a non-resident, that's going into our super fund as a concessional contribution, that means we only have a $15,000 catch-up concessional contribution that we can roll over to the next year, which means that in that year we could technically contribute up to $40,000. So that's at 15 plus the 25 for that next financial year. With the residency tests on returning, could you sell day one? Extreme case, so long as you meet the residency test by the end of the financial year. Listen, it's a bit of a grey area, really running a big risk there in selling day one, because at the end of the day, if your circumstances change and you leave again and you've only been in the country for, say, a month, you haven't satisfied any of the residency tests to re-establish your tax residency, even if you just look at the criteria. Personally, I wouldn't want to run that risk. But again, always maybe worth having a personal consult on that one to learn a bit more about the circumstances that surround that. What if I joint own the property with a tax resident of Australia? Would this tax only be portion of the sale? I might just read that one out one more time. What if I own the property jointly with a tax resident of Australia? Would this tax only be apportioned my part of the sale? Absolutely. So if you're selling a property after 30th of June 2020, one of the individuals is a normal Australian tax resident, whether it's a friend, a family member, you will have to pay tax on your portion as a non-resident, and they won't, assuming that the main residence exemption covers the other individual. Okay, just moving through these. Follow-up. Okay, yep, this is a good question. I'm glad someone's actually asked it, because it's something you really need to be careful of. And I trust shifting ownership percentage instead of reasonable options. It's a good question. I mean, not really, to be honest. If you're transferring a property into a trust, you're going to have to pay stamp duty on that transaction. It is a CGT event. In the event you're still benefiting from the main residence exemption, that's probably the only reason you might do it. Therefore, it's technically a tax-free transaction, but you'll still have to pay a substantial amount in transfer costs, transfer duty. I question the viability of using family trusts if the sole beneficiaries of a trust are only non-residents. You're still taxed at 32.5% on that income. Capital gains, you don't benefit from the 50% CGT discount concession. This is a question which is mainly about residency. Can spouses who are married technically live in different places for tax purposes? It's not really relevant to today's webinar, but yes, they can technically, depending on the circumstances. What about if you rent for longer than 6 years but then return to Australia, take up residence in your house for another year and then sell? Let's just recap that one. What about if you rent for longer than 6 years but then return to Australia and take up residency in your house for another year and then sell? In that case, you're a normal Australian tax resident, you haven't rented it past 6 years, you would benefit from the main residence exemption in full, based on that short question. There's a few more questions coming through here, just mainly asking about personal opinions. As we all know, it's really bizarre that this legislation has come into effect. I think the government has a skewed perception of what an expat really is. They think they're targeting these ultra high net worth, wealthy individuals when, based on our previous expat surveys that we've conducted, the main sort of, I suppose, industries is education, health, obviously legal, just ordinary Australians, mum and dads that, are working overseas on similar incomes, but they're, obviously they've gone overseas for career pursuits. The fact that this legislation is now into effect, we don't see it rolling back anytime soon. There's plenty of lobbyist groups still trying to change the government's minds, but essentially it's draconian. It's purely retrospective in nature. Might be a case that in the future, due to its retrospective nature, that could be a reason that it does get overthrown, but there's no whispers or sniff of that coming to light anytime soon, unfortunately. So it's either do nothing, leave the property as is, whether it's vacant or rented out, and do not sell whilst we're a non-resident, and then maybe sell it as a normal Australian tax resident. If the property's benefited in full from that 6-year period already, then potentially selling it over the next 4 or 5 months might be your best option, and then looking at other opportunities in ways that you can still accrue some sort of retirement asset through maybe the capital that you've liquidated as a tax-free asset. There's options there. Let's have a look at a few more questions coming through. I'm going to actually wrap it up shortly, but let's have a look. This is when some of the good things come through. Question here, who and how do I find someone to provide an independent valuation? A good question there. There's plenty of firms around Australia that do independent valuations. If you even just type into Google, the suburb or the state or wherever it might be, as an example, we're down the road from Brisbane. Brisbane independent valuation firms, I'll probably get 5 hits. There are plenty of firms that are out there. Again, a real estate agent will not hold up, I suppose, if the ATO ever audits you based on that market valuation rule. It needs to be a formal valuation from an accredited firm. A real estate agent does not hold up anything against that. If we're seeking a formal valuation of the property, say now, it's likely to cost you a few $100s. If it's a valuation from quite a long time ago, it could be a case where it might cost you a bit more, $1,000 or $900, but that valuation is worth its weight in gold in the event you sell that property as a normal Australian tax resident, because it's going to benefit you from a capital gain or reduced capital gain point of view. Okay, a few more. Here we go. Good question here. Do you need to be working to contribute to the super you are talking about? My contributions over the last 7 years have been post-tax, so not taxed by super. So that means they've been going in as a non-concessional contribution. If you don't have to be working, how do you make these deposits in super with 15% tax? It's a good question. Now, if we've been making after-tax contributions, which is the non-concessional kind, which is $100,000 per year, that's the cap that we're given, or we can technically trigger the bring forward rule and make it a lot more. I won't go into it. That means that those contributions that you've been making do not, I suppose, contribute to your concessional contribution cap each year, the $25,000 amount, which is the pre-tax amount. When we contribute to super, assuming we haven't made any concessional contributions previously in that financial year, that's going to blow us through that $25,000 cap, when we contribute those funds and we know we want to claim that as a tax deduction in our individual tax return, there's a form called an S290 which we must complete. Sometimes a super fund will complete this on our behalf if they email you with a notification asking you, would you like to claim this contribution as a tax deductible concessional contribution? They'll pre-fill it, they'll take out the relevant tax, they'll send you a confirmation letter, that way you can provide that to your accountant. In the event they don't, it means you need to complete the ATO form, which is about a 3 to 4 page form, confirming the amount you've contributed to your super fund that is to be used as a concessional contribution as a tax deduction. That way the super fund knows to take out the 50% tax. They'll send you a confirmation letter of the amount, and that way you can give that letter to your accountant to claim as a tax deduction. So a few more questions coming through. I'll do my best to try and answer them. Can the value at rental date be lower than the purchase value? Absolutely. There's plenty of suburbs which we've seen gone backwards. There's some in, it depends on obviously where the property is. I mean, probably a good example, unfortunately, with all the fires that are going on in Australia, is that there are a lot of suburbs which, in terms of capital growth, it's reset these property values to a fraction of what they used to be, just due to obviously the local town, the infrastructure, and the years and years it's going to take to rebuild those communities. So based on those circumstances and those, I suppose, black swan events that occur, then it's likely that a lot of those valuations will have come down. In the event you do seek an independent valuation, it's less, and it's obviously just apportioning that for that period that there's actually technically been a capital loss, because you've got that independent valuation that helps. But because it's gone backwards, and if it resets the cost base to something less than the original purchase price, just remember that it means that should you sell that property in the future, you've accidentally just increased your capital gain potentially. So just bear that in mind, that in the event you get an independent valuation, the accountant doesn't need to use that. As I said throughout the slides, they can use what's called the apportionment factor, whereby they use it based on the days of ownership, the days of you being a normal Australian tax resident and non-resident, as well as the days that it was rented out past that 6-year rule. It's an important one to remember, that in the event that the valuation comes back for the market value rule and it's less than the original cost base, it's likely that you're going to pay more capital gains tax than you need to. So that's a good question. So thank you for raising that. There's a good question here. Just want to, I suppose, make a point that people need to meet the super contribution cutoff dates. Example, property sold June may not give you enough time for that financial year cutoff. That's a very good one, Martha. Thank you for mentioning that. Now again, a lot of people, sometimes they get confused where if the contract is signed before 30th of June 2020, but settlement takes place in the new financial year, that they think that obviously the transaction or the contribution should be made in the new financial year. Not the case. And it's one of the things that's actually a bit of an unforeseen issue, whereby we might realise a very large capital gain on a property, and as a result of that capital gain we sign the contract on, say, the 15th of June. Unfortunately, we're likely not to receive the funds for probably another month or two. In that circumstance, there's nothing you can do by way of making a concessional contribution for the previous financial year. The cut-off date for most super funds to process those kind of concessional contributions is about a few days before 30th of June. It's got to be in the actual super fund by 30th of June, not I'll transfer money on the 30th of June and hope it lands in that account. But that's a very good point, that whilst we want to make that concessional contribution or the catch-up concessional contribution, it needs to be in before, well before June 30 if settlement's taking over. or taking place in the next financial year, there's not a lot we can do there, unfortunately. So again, as we're in the year of 2020 financial year, means in the current year we can technically utilise a $50,000 concessional contribution, because $25,000 for the 2019 financial year, 2020 another $25,000, under the assumption that no previous concessional contributions have been made. So some good questions coming through still. Withholding tax, there's a good question here. In terms of the withholding tax, from what I've seen, a lot of people have gotten out of paying this withholding tax, so that's that foreign resident capital gain withholding tax amount. But they're usually onto it pretty quickly when they know they're selling the property. They've engaged either a solicitor or a tax agent to make sure they lodge the appropriate forms for them early based on the contract being signed, and then they're submitting the correct forms with the ATO straight away to either seek a clearance certificate or vary the amount to zero immediately. So no withholding amount is placed. In the event that tax is sent to the ATO, there is ways that obviously you can get it back, that isn't gone, or either it's an early tax return, or you just be patient and do a tax return, obviously at the end of the financial year, and that's when you'll receive that tax refund. So again, that was introduced just as by way of a lot of individuals not lodging those final tax returns, and therefore the ATO not giving that final piece. A few individuals wanting just some private, I suppose, clarification on their own situation. So guys, in the event you want a specific or more information on your own circumstances, we're more than happy to help. Best thing to do is email us at info@atlaswealth.com. Obviously our website's there as well, www.atlaswealth.com, and if you reach out by one of those methods, either the online contact form or the email address, it'll come through to either myself or Brett, and we'll come back to you in a timely manner just to address those specific queries that you might have. So I do appreciate everyone joining us today. There's a few more questions coming through, but I'll try and address some final ones. Just trying to get through them all. And there's a few ones coming through about 50-50 ownership, deceased estates. Those ones I'll address personally. So if you can just send through an email on those ones, just because it depends on the individual circumstances, ownership periods, whether the deceased is foreign resident or the individual receiving the inheritance is a deceased, is a foreign resident as well. There's a good question here from, sorry, I won't name names, but I'll just mention it and read it out. Our property is rented through the holiday platforms. Holiday platforms, I can only assume that's Airbnb, those sort of ones. Is there any specific around this, i.e. if the house is vacant more than it is rented each year, are there concessions on this? Well, if it is being marketed for rent, then it's still seen as, I suppose, that rental period, because it's highly likely that you're not apportioning your tax-related deductions, council rates, those sort of things, for periods in which that it's not rented. It's available for rent, and it means, technically speaking, we can still claim those tax-related deductions. So if it is marketed on a platform, it's still counted towards a period of potentially being tax deductible. If it's not marketed at all, the house is just vacant, it's not on any platforms, anything like that, then it's highly likely that that does not accrue towards a period of being that 6-year tax relief rule, the main residence exemption. It's a tough one, that question, but remember, even if we've used 6 years and now as of 30th of June 2020 we keep our property vacant, doesn't matter. If we sell the property as a non-resident, we'll still have to pay tax on it all the way back to the original purchase price. So moving through a few more. There's some long questions coming through, and I do apologise if I'm not getting to them. It's just tough trying to read them out to the audience as well, and they're more of a personal nature. So just still going through these. Okay, good question here. Could you please address the situation if you inherit a property as a non-Australian citizen, is this just the same as a non-Australian resident? I may have to give up my citizenship. Okay, so if you're inheriting a property as a non-Australian citizen, you've never been a tax resident of Australia, then yes, you're treated the same way as a foreign resident or a non-Australian resident in that circumstances. What's somewhat annoying about the ATO's website, when you go in there and you look at tax rates and you look at other things, it doesn't really say anything about non-resident Australian or anything like that. It always just says foreign resident. But if for tax purposes you're a non-Australian resident, then everything that is talked about with regards to foreign residents is highly likely that it is related to you. So just a careful sort of item just to remember when we are going through. Some more questions coming through, still trying to get to them all. Let's have a look here. Again, important date is 30th of June 2020. Contract must be signed prior to that date. Again, if you are going to utilise, the concessional contribution strategy, and let's say that you've already rented out your property for a period of greater than 6 years, then you'll still benefit for the 30th of June 2020 transition period. But if you were to sell over the coming months, do so in a manner which gives you time for settlement. That way you have the funds and capital to utilise maybe a $50,000 concessional contribution to bring down your overall tax position. Because remember, if we're receiving a partial main residence exemption, it means that some partial amount of that capital gain is still going to be taxable. So you can offset that. And if you're a non-resident, rather than paying 32.5%, we'll only pay that 15% on that contribution that goes in to the actual super fund. So just bear that in mind. Just some last questions. I'll try and get to one more now, just trying to see if one of these long ones I can read out. Let's have a look here. This is more of a US tax resident related one, but I might mention it just because I know a lot of US tax residents, Aussie expats, have tuned in. Hi, we have been living in the US for 2 years and are non-residents for tax purposes. If I sell before June 2020, is there a point as the US will charge me CGT even if I'm exempt from paying Australia as I'm paying tax in the US? First point to mention on that item is speak to a local US tax accountant, because the US has its own main residence exemption depending on periods of ownership, when you last lived in the property. It's generally speaking, per an individual on a former main residence, we can apply a $250,000 US capital gain to that property. That's step one. So approach a US tax accountant for a brief what-if analysis. I lived in the property only 3 years ago. It was my main residence for a long period. What kind of tax would I have to pay to the US in the event that transaction transpires? Obviously on the Australian side, if you're still benefiting from the main residence exemption because of that transitional period and the capital gain is still quite high, one item which is actually in your favour is the fact that the US, the currency at the moment, the exchange rate is quite strong on the US side. So Australian dollar is not worth what it used to be, and therefore it's highly likely that you might not need to pay tax. But again, seek a what-if analysis from a US accountant on what that might be in terms of whether it's a taxable transaction in the eyes of the ATO, in the eyes of, the IRS. Just moving through, got time. I might do one more question and then move through trying to upload this on YouTube shortly. Let's have a look here. Just bear with me, just scrolling through them all. A lot of questions that have come through and are somewhat coming through already. I've sort of already addressed them either through the slides or previous Q&As. So I'll do my best. I'm just trying to find one that is a bit unique. Let's have a look here. Michelle, good question. I heard that there is also a US tax payable on the foreign exchange gain on the payout of an Australian mortgage upon sale. It's a very unique, specific question, but yes, potentially, depending on the date in which you acquired a mortgage in the US, you might have a foreign currency gain to pay when the mortgage is paid out. It's dependent on the period and the exchange rates at the time of sale and when first entering into that mortgage. That's not really specific for everyone. Let's have a look here. One more. Sorry, just scrolling down through all of them. There's a lot of tax residency questions about returning to Australia and trying to resume tax residency for the purposes of that transaction. Again, it's a bit of a grey area. Generally speaking, you really want to commit to a move, and obviously from the ATO's point of view, they want to see that you've committed to a move back to Australia permanently, whether it's a case you're moving back into that main residence or you're renting. If you're renting, you're obviously signed a 6-month, 12-month lease. You'll be in Australia for at least 183 days in the same financial year. You'll have a power bill, you'll have obviously an internet bill, you'll have a phone bill, you'll be in the local community, you'll have gym memberships. You'll do everything that looks as though you've moved back permanently to essentially be a normal Australian tax resident. Again, as I said previously, Commissioner of Taxation with this new piece of legislation will be leaning on that Part 4A, the anti-avoidance rule, whereby they can challenge previous 4 years, 4 financial years. So in the event that they've got a case where over that 4-year period, let's look at a quick example. An individual comes back, they're only in Australia for 6 months, but they're going to treat themselves as a normal Australian tax resident for that 1 year. In the event that that's the case, and then they head back over to the US or to Singapore or whatever it might be, and they've only been an Australian tax resident for 1 year, but then going forward they're a non-resident for the following few years, I think from the Commissioner of Taxation's point of view, they might want to query some of those transactions and conduct rare audits, because in the event that the sale is quite large, it's highly likely that the ATO want to know more about your circumstances at the time that you perform that kind of transaction, to see whether you were just trying to avoid tax by being back in the country for a short period. So it is a bit of a grey area. Definitely seek advice on it. Speak to a tax agent, tax lawyer, I suppose tax registered financial advisor, just so they can address those specific questions. I might wrap it up there now, ladies and gentlemen. I do appreciate you joining us today. Again, as previously stated, there will be another webinar later today in the afternoon if you haven't been able to attend this one, depending on where you are in the world. If you have specific questions about your own individual circumstances, please do feel free to reach out, info@atlaswealth.com, or you can submit an online contact form at www.atlaswealth.com. If you're not following us on any of the socials, we are on there. Obviously, if you're on LinkedIn, we have our LinkedIn page, Facebook, that's where we share all our information updates, Twitter, as well as Instagram. We also have our own Australian expat financial group as well, linked to us. We control it. We're the only individuals who control it, and it's mainly just Australian expats posting queries, concerns, and we do our best to get on there and address them as well, and we share all updates through that group as well. So I do appreciate, again, that you joined us today, and obviously I'll let you enjoy your evenings, and obviously the recording will be available shortly in the next day or two, and obviously hope to hear from some of you. Appreciate your time.